How the next 20 minutes we'll talk a bit about the current status of how the markets seem to be looking and what to do in a scenario like this with specific funds or with a specific category of funds. There are some questions that have come in around a change of a head honcho around a mutual fund house. And because there's so many questions around that, we'll try and take that as well. So you would have guessed which I'm talking about. And getting our guests on the show to talk about this. Karthik Zaveri, Director of Investments of Transit Capital, and Juzair Gabaziwala, Director at Ventura Securities, join me right now on the show. Gentlemen, both of you, thank you so much for taking the time out and joining us. Really appreciate. Um, Juzair, I'll start with you. A period, I mean, the last 5 weeks, the indices, at least the headline indices, have been in a bit of a consolidation mode. So a mutual fund investor would be thinking whether it's a good time to actually take exposure to low vol funds. If indeed the predictions might be that the year might actually be very, very choppy. What is the advice that you're giving to such questions at your outfit to mutual fund investors?
So first of all, I think, we mutual funds will keep on creating new products, just to create some appetite and buzz. Okay, so you have to be very careful. Volatility and equity, actually, they go hand in hand, right? So, if somebody is not going to be looking at volatility, you have to think about whether you would actually want to be in equity as an asset class, right? Because, whether you call it, low volatility, the more important question is actually going to be what is the risk appetite, right? So even the low volatility will also be classified as high risk, right? As per the SEBI categorization, because they would still come under the equity category. So my personal belief is that, if a client is actually looking at equity, and then if he's going to be talking about volatility, it is better to avoid that as an asset class and rather be into another asset class. But in equity, you should be you have to embrace volatility. Volatility is what is going to make returns for you in the long run. The tenure is more important than trying to play it for the short run.
Okay. Interesting answer. Thanks for that, Juzair. Karthik, the same question to you, and your answer may be different, really. But if people want to be in equity but have a lower appetite for volatility, would low volatility funds be an option, or you don't agree?
No, I think it's very, very different, because for me, everything is based on financial goals, the situation of the person, what his long-term vision is, what his current circumstances, and how he would like to plan his life in future. So a lot of times, a lot of brokers and advisors do ask for movements and do suggest these moves, because there's volatility. Let's go and stay at a safe zone for some time, then come back. But it's almost impossible. I mean, we've seen time and again, it's impossible to say. Who's to say that today we are at a high or today we are at a low for the next 10 years and things like that? So my sense is, yes, why not keep some cash available? It's always a good idea to have about 20-30% cash. Nothing wrong with doing that. And when you find that the market dips, on every time you see a market is the broad index is down by 2-3%, I mean, which is like a serious amount of discount that you will get for a lot of stocks. I mean, if the market is down 2-3%, individually stocks could be down 5%, 8%, 9%. So these are days on which you should probably buy. These are days when if you have liquidity, buy that mutual fund. These are days to do that lump sum kind of a purchase also if you want. But otherwise, generally speaking, the best way to handle volatility, and if you think there's volatility, then you expand your STP duration. Now, what we tend to do a lot of times is when we invest in mutual funds, we tell people, okay, market's looking volatile, so we'll divide the money into 12 parts. We'll enter the equity markets into 12 zones and divide it further by a week. And in 52 steps, you are entering the market. Okay. If you are feeling aggressive about it, then within 6 months, you deploy the money, 4 to 6 months. Break the money by 6 into 4, 24 weeks and get in. If you are extremely conservative about the whole thing, well, take 18 months time to enter the market. But then, of course, don't take anything longer than that, because then you'll miss the rally also on the top side. So in that sense, if your goal is retirement, children's education, buying a new home, making down payment provision, doing something which you're going to spend after 10 years, how does it really matter? 10-15% volatility is going to mean nothing to you. So by all means, then, stay put with your equity strategy. If your situation is that this is that part of your portfolio which needs to be in debt or at a lesser risk quotient, then by all means be in the balanced advantage funds and be in the hybrids. In fact, you could even be in the pure debt funds, because debt funds will also have a cycle. Somewhere I feel that the interest rates in India, and given the Indian situation, we are more comfortable than the rest of the world. We may not find that recessionary or inflationary pressure in our country. So sooner or later, we will find interest rates actually starting to reverse, and which means, if you are invested into a debt kind of a fund now, whether it's a simple short-term debt fund or a banking PSU fund, or something as advanced as a government securities fund and corporate bond, I think going 2, 3, 4 years ahead, you might actually make good money there, because as the interest rates keep coming down, your gains will keep heading higher. So my sense is, Neeraj, I would segregate things. For the items that I need for my long-term, activities, my long-term goals, my long-term aspirations, equity is absolutely fine. And otherwise, I would not make tactical allocations based on कि अभी क्या लग रहा है for the next 6 months, and then take a decision based on it. But for my liquid requirement, for my debt requirement, I might want to slow down. That's the
Fair call. So, Karthik, just a quick follow-up there for somebody who's got a time horizon which is about, say, 6, 9 months, because people believe, there's a lot of conversation around how the first half might be choppy and the second half might be okay. So somebody has a 6 to 9 month horizon for parking money in debt products until the time she or he actively takes a decision herself to invest in equities. What's the best debt option to do that? The time horizon is 6 to 9 months.
So let's go to a banking and PSU debt fund, and we will earn a good 5.5, 6%. And because it's a mutual fund, so we'll talk about that fund. But for the benefit of viewers in generality, consider also the option of peer-to-peer lending. You might also get a slightly decent rate there. 6 to 8 months, 9 months is, you don't need to worry about it. 10 years later, it'll become a very everyday thing to talk about P2P lending. But go and invest there also. You might get a rate which is as high as 9 or 10%, of course, on an annualized basis, but your net realization will be higher than that of a banking PSU fund or a short-term liquid fund also.
Jose, just same question to you before we move on to the next topic. For somebody who's got a slightly shorter term horizon on the debt side, is a banking and PSU debt fund a good option, or do you have some other recommendation as well?
So I would actually so in debt also I would look at it that how aggressive the guy wants to play it. Okay.
Let's assume the lady is a moderate investor, Jose. I mean,
okay.
we consider
moderate. Then frankly, the person should just look at a short-term debt fund, as an option, or ultra short-term, so that because the shorter-term, YTMs are much better than on the longer duration, because banking PSU would be having much more larger, maturity papers, and if there is a 0.5% hike over there. So if supposing interest rates go up by, let us say, another 0.5% from here in the next 3 to 6 months, then the impact on a banking PSU fund could be much more than on a shorter duration fund. So it is better to be on the shorter duration side than to be on a trying to be aggressive on a longer side, and specifically if the person is having a moderate risk-taking ability.
Okay, fair.
So that is what I would advise.
No, which is a fair point too. Karthik, you want to quickly respond to that? I mean, just in case, because I didn't qualify the risk appetite of the person. If the person is not a high risk investor but a moderate risk investor, would the banking PSU debt fund still be a good option? Or as Jose suggests, that maybe there could be a hit and therefore some other option might be better?
Yeah, there could be a possibility of a little bit of a downside movement to it, which is why I would stick to things like P2P, because there is no such movement activity. It's not a mark-to-market kind of a product.
Sure.
So if you're ultra conservative to a large extent, yes, I agree. What we should do is either go into a fixed deposit, just eliminate all sorts of doubts whatsoever, or then get into a P2P instrument so that, your return is more or less clear-cut defined before you even enter. Your exit is also very clear-cut defined.
Sure. So viewers, on a mutual fund show, you got non-mutual fund options as well. So well, that's the point. Okay, thanks to that, both of you. Karthik, the second question, I'll start with you. And there's a lot of people who have actually written, and which is why this was important to take. Normally, it may not result in anything, and I know the answer would be to let's wait and watch. But IDFC Mutual Fund has a change at the helm of the equity investing. Right, Anup Bhaskar is moving out, Manish Gunwani is coming in, both accomplished, but both have different styles, presumably. So, Karthik, to you first this time. For people who are invested in the equity funds at IDFC MF, should they take any decisions to change or alter their positions out there in IDFC MF schemes?
Okay, the first of immediate gratification answer is do nothing. You don't need to do anything whatsoever. So that's the answer. That kind of puts most of the people's thoughts and confusions at rest. But then now let's sort of expand it. If you look at the history of our mutual fund industry, I remember a time there was a mutual fund called Kothari Pioneer, and then there was ITC Threadneedle, and then there was Zurich, and then there was HDFC. All this kind of sequence of events happened. I have even held funds through ITC and its journey into Kothari, ITC, Zurich, and into HDFC and things like that. So it's okay. These things are normal, and in the recent past also we've just seen a restructuring happening with L&T mutual fund as well. Well, when L&T and HSBC took over the L&T's business. We've seen all of that. Nothing structurally to really redefine your mutual fund portfolio just because the just because the leadership has changed, right? What happens is there are always some funds which will be in the top quartile or top decile in this case of IDFC. So two of their funds, Sterling and Tax Planning, are already doing well, and they are in the top 10 on a 3 or 5 year, almost on a 10-year basis also. Somewhere it's on rank 11, which I just saw. But otherwise, it's there at the top 10, right? The others are laggards. So whenever a new management comes in, we hope that they will fix the challenges of the past, and they will make their other funds also better. Now, they have a motivation to do that also, because if they make their other fund performances better, naturally investors would get attracted to do it. Brokers and distributors would recommend their fund, and that also results in profitability for the fund house itself. So whenever there is a change at the top level, I think it's a welcome move, because there are new thoughts, new ideas, new energy, and some new activity gets infused into the organization. And we can always hope for a better future. So at the moment, I don't think there's anything that you need to worry about. Debt fund side also reasonably all right performances. There's nothing to prompt you to get out of it. There is no scam. There is no negative news of such. And leadership change is the normal thing. Restructuring, acquisition of one mutual fund from the other. Very normal, very fair, standard, activity of business. So I would think just relax on that and don't worry too much. They've been doing fine. If you find something seriously wrong going forward, then we'll take a call.
Okay. Juzair, to you as well. On the debt side, of course, Suyash is a able fund manager, so that doesn't come into question. But on the equity side, if people were, or if you believe some of the IDFC schemes were doing really well because of Anup, and now that Anup is moving out, though Manish is coming in, does it make you think that maybe if you had exposure, you would change?
No, so I don't think even whatever Karthik said is absolutely correct. There's no point in trying to have a knee-jerk reaction. It's like, and one point which he maybe, he didn't, we had seen one of the biggest change, right? You had seen Prashant Jain moving out, right, from HDFC, right? And I don't think anybody asked the question at that point of time. But the processes have been set in place, right? So I think the more important is that, in fact, let us look at when Manish also came into Nippon, right? At that point of time also we have seen that there were changes. So I think important thing is to also understand the journey of the person. So Anup has been also had a great run at Sundaram. I mean, we had Sundaram Midcap having a excellent performance right throughout his tenure. So he made his mark over there. He moved to UTI, he moved to IDFC. So nothing to take away from him that just because he moves out and somebody else is coming in. So every individual will have his own aspirations, right? And I believe that people will keep on changing at any of the fund houses. So this is something which each investors will have to take it in their stride, that this is going to happen. Now whether how it pans out ultimately, it is going to be a wait and watch, because as even Karthik mentioned that you get new ideas, new thought processes. So I think we should always believe that we always believe change is a only constant, right? So we have to keep on accepting the change, moving forward. How it is going to pan out, actually time will tell, because if you'll exit today, I mean, how does it matter? Is it the same? There's no change in your portfolio, so you cannot say that you are basing your decision on the basis of what Anup going out or Manish coming in, because there are other fund managers also, and each fund house now actually tries to look at having a process in place so that the process does not undergo a change. So I think, and everyone is trying to institutionalize the entire thing, because we are going to see a change of guard at a lot of places, and it is going to happen. And because now
Got it.
we are at a stage where the mutual fund industry is also growing, right? So
Makes sense. Well, just so many questions that had come, so I thought it was just pertinent to get that. But I'm hoping that people got their answers. Both our experts believe there is no reason to make any immediate shifts. Maybe bide your time, viewers or investors. And if you believe that at some point of time in the next 6 to 12 odd months, there's a bit of a change in the grain. If you indeed analyze that mutual fund scheme so closely in the first place, then you probably got to maybe take a decision. But otherwise, our experts believe no need to bother with that. My final question really on NFOs, because there were so many of them touted to open, some open or some are open, some of them will open over the course of the next 6 to 12 odd weeks. Any NFOs, Juzair, that you are watching out for in the period of the first quarter?
So nothing specific as of now, because there's nothing which is something exciting or new theme or something which is coming up, right? But to connect with your first part of the question, so it's like, if somebody is looking at like to trying to time the market, and he feels that now the market is too high, right? Then an NFO is a good time to get in, because the fund manager has to start on a clean slate, and he will have time to build up the portfolio. He will also be seeing the same stocks, right, in terms of whether to get in now or whether to hold. So where people don't want to have the headache of doing a STP over a period of 12 months and doing all that, so the NFO becomes a good entry point for those investors. So because otherwise most of the categories are already covered. I think all fund houses are only trying to fill in the gaps which they don't have, and we are seeing some more action more on the thematic side. So as of now, there is nothing as a particular segment which comes out as a real standout or a very, very differentiated product. No one is coming out with a very differentiated product which looks very exciting or anything as of now.
Okay, Kartik, same question to you. Any NFOs current or in the near future?
I subscribe to the views of user 100%. I mean, there is nothing new. See, NFO is something that I would look at when there is a new innovation, new idea, or there is a compelling case. For example, there are in the past, I've seen a situation where, as the small caps were really beaten once in the last, I think somewhere around 20, there was 2013, 2014 also, we saw that 2018, 19 also. So there was a case that if a small cap fund is coming here, the index is already down, the opportunity is tremendous, and even then, in that case, even if there's a close-ended fund, we would go ahead and make some recommendations there, because the opportunity was actually visible. Or there is a completely new innovation that happened, something that we've not had. Or we were getting opportunity, let's say, to get into a Brazilian market or a natural resources or a new energy or a renewable energy kind of a fund. Something completely different, or a water, or something which we've not done before. Then yes, NFO. So in my view, and something I've maintained, that most of the times, NFO is not really an opportunity for investors to come in. It is actually a business strategy for the fund manufacturer. So it's not something that is an open invitation. Come and subscribe. You'll get something cheaper at 10 rupees and things like that. Is the fund manufacturers to do it. Sometimes you want to watch performance and do it. Sometimes the Me Too product. Sometimes, like Zubair said, it's filling up a gap. All those things happen. So nothing really on the NFO front that we are recommending. There are a couple which are already existing. But those themes are already available in the market. So just because they're coming out new, there is no reason why we'll make an allocation to that, even if they're coming from a great pedigree of a good house. So all said and done, I think there's nothing on the recommendation list at the moment. We'll just play by ear as it moves along, see the performance, and then some point of time make allocations. But investors need to remember, it's not an opportunity for you. It's a business for the mutual fund. I mean, it's a business case, straight for it. So why not do it? If I was in their place, I would also launch a fund if I didn't have one, or I saw an opportunity there. But don't get, what I'm trying to say is, don't have that fear factor getting into you. Don't have a FOMO getting. That's the word I was looking for. So just because you don't invest in the NFO doesn't mean you're losing out something. There are enough and similar products available in the market. There's got history also. You are listening to a lot of financial professionals. You're probably doing your own due diligence also. Look at the market, look at the situation. There is enough opportunity.
Sure.
No harm done if you go into an existing fund. But there's no FOMO here.
No FOMO here. And I think that's the common view. Well, in a manner of speaking, both our guests have had common views on most topics that we've spoken about today. Karthik, Jose, take a moment to thank both of you for joining us today and giving us your perspectives on 2 or 3 things, amongst one, which was which is something that a lot of people had asked for. So really appreciate your time and thanks for joining in today.
Pleasure.
Thank you, Neeraj.
Viewers, thanks for tuning into this leg of the Mutual Fund Show.